Hello, everyone. Sorry for that quick delay. Tech is always fun. But welcome to episode 10 of Stella Vision, Stella Rising's weekly marketing update. I'm Marlea Clark, CMO. Thank you so much for joining us. As always, we continue to think about, talk about, and act on very important social issues this week. And we are also continuing to support brands as they rebuild from the COVID crisis. Today, I'm so happy to have our Chief Digital Officer, Brandon Heagle, back to discuss what's happening in the digital and e-commerce landscape as the physical stores begin to open at different rates across the country. Brandon is really staying so close to the pulse of those broad consumer trends, looking what's happening from so many different data sources, as well as those within our own specific client portfolio, to see those trends and help us and our clients strategize for what's coming next. Please, as always, submit questions as we go in the panel. And also, please feel free to reach out to me or to Brandon anytime. Right now, let's get started.
Thank you very much, Marlea, and thank you everyone for joining. Happy Friday morning. So today we're going to be talking on episode 10 about the evolving COVID-19 economy, retail and e-commerce trends and predictions in terms of what we're seeing and what we're expecting. Apologies. There we go. Got a little frozen there. Gotta love technology. So starting out, we wanted to talk about how the pandemic is impacting online behavior. So we've seen, certainly, as we've all been home, as a result of the quarantining and staying home, a change in our own personal behaviors. And that's really been seen broadly across a number of the consumer sector. And there's some trends that really started at the beginning of the pandemic in terms of, people are spending more time online. People are consuming more media than they were before. And it's natural, right? You're home and you're looking to keep yourself entertained, you're communicating with friends, and you're doing so virtually at a much higher rate than you were prior. So initially, it was roughly about a 20% immediate uptick in terms of web traffic. And there's been a range of anywhere from 20 to 50%, depending on who the broadband provider is. But what we're seeing is that that's starting to normalize now, that the new normal is roughly, according to Comcast, about a 33% elevated web traffic level. And that's really stayed pretty consistent over at least the last month or so. So although there was an initial surge in traffic online, it's kind of plateaued and stayed at that elevated level. And I would expect that's going to continue to happen going forward until people start going back into the workplace more aggressively and things change a little bit. But, especially heading into summer with children being in the homes and things, it's likely going to stay at a pretty elevated level for some time. Also, consumers are consuming more media. So especially things around entertainment, social communications, video, gaming has seen a significant uptick, and we're expecting that's going to continue as well. More people spending time indoors, more people at home, that's going to continue to be something that will take place. Spending is up. So from an e-commerce perspective, people are spending more money online. Originally, the forecast was roughly about a 13% growth. eMarketer, we're going to talk about a little later, actually revised their forecast this week an additional 5 percentage points up to an 18% e-commerce growth, which is the highest growth level seen in a number of years. And that makes sense as consumers are not able to get their goods and services, going out into the retail space in the physical world. They're, trying to get what they need in terms of, e-commerce, acquisition. Additionally, consumers are making less trips out to the store, and when they do, trying to buy more in each visit. And so that's also something that we're seeing as people are purchasing more and more in e-commerce, through e-commerce. Additionally, investing more time in messaging and socializing. So, people now, because they're not interacting in a physical sense and able to spend time in a community gathering sense and spend time face-to-face, they're now using Facebook messaging and other messaging and Zoom and web conference as ways to stay connected with their loved ones, friends, family. And so Facebook recently had launched Facebook Rooms. You'll start seeing some ads for that if you haven't already. And they're trying to really capitalize on the trend of saying, hey, use Facebook Messenger to create private rooms where you can have group chats and things of that nature to bring everybody together. And Facebook has reported that they've seen an increase of about 50% in video calling, in messaging, and that video calling is doubled in some of their markets. So The other thing we're seeing is that e-commerce is continuing to grow at accelerated rates. So in the last 2 months or 3 months now, it's grown more than it has in the past 10 years. So if you look at US e-commerce penetration, you can see that that's up to 27% already in the last couple of months compared to, a pretty steady linear growth rate that we were seeing prior. And again, we're crediting a lot of this e-commerce growth to the fact that people are not going out into the physical retail world. And the pandemic has really accelerated certain categories, especially things like e-grocery, and brought a lot of consumers into e-commerce purchasing for the very first time, especially some of the elder demographics. And so we're continuing to see that penetration grow in terms of the percentage of overall retail sales. As we look at where that growth is happening, really where we're seeing most of the growth happening is in a couple of key categories. Anything that makes things more convenient, kind of utilitarian benefits, things that are essential, and things that are kind of solving boredom or helping people stay entertained. So you can see as you look at the overall trend line, effectively what happened is we had a pretty consistent baseline going through January and February. And towards the end of February, beginning of March, as the pandemic started to hit and people started to sheltering in place and getting more concerned, everybody kind of pulled back. And we saw, media rates start to come down. We saw brands start to pull their advertising dollars in March. People kind of took a pause and really were trying to figure out what they were going to do and what they should be doing. And so we saw a little bit of a decline. And then for those of you that have been tuning into these televisions on e-commerce, you know that April, we saw pretty much an accelerated growth. And you can see that represented here across these categories. What we saw in May is that things started to normalize a little bit, but at a new normal. So you can see elevated search volumes. You're going to see in a few slides elevated e-commerce, a lot of that growth happening. And really what's happened is things have normalized, but at an elevated level. So even fitness, you can see here where there's a big jump as people knew they couldn't go to the gym, they want to stay in shape. They jumped in to say, well, all right, let me figure out how to do that at home. Let me find some different, different sort of workout equipment and things that I can do in routines within my home. And so a lot of those things kind of had an adjusted outlier growth rate. And those are starting to kind of normalize towards that new elevated level. So you can see fitness, sporting goods, home and garden, home improvement, computers for work and productivity, toys and games for entertainment. Of course, food and groceries has been elevated from the very beginning of the trend as people try to avoid their visits to the grocery store. The other thing that we're seeing is that some of the categories that were laggards in the beginning, things like apparel, things like jewelry, they were really kind of the first things that people kind of cut out as they started to have some economic concerns and financial concerns, and they really wanted to prioritize their spending on the essentials and the necessities. And so what we're seeing now actually is for the first time now going into May and now into June, that some of these categories are starting to recover as well. So this kind of is a similar trend to what we saw on the previous slide, but there was much bigger dips in terms of these non-essential categories. So now represented here, pants and jeans are seeing about an 18% growth in search volume according to Google Shopping. Similarly, beauty was something that we at Stella Rising do quite a bit of work with a lot of beauty brands, and we've seen pretty sustained growth through our portfolio. But as a category overall, there was also a retrenching back in March, like there was with many other categories. But now we're seeing significant uptick in May, which is holding into June for a number of different beauty brands. Looking at the category distribution, you can see things like face cleansers and lotions, kind of things that are part of the everyday routine are continuing to kind of really lead the pack in terms of category growth. Makeup is starting to kind of make a resurgence. It was a little slower in the beginning, color cosmetics, but now we're seeing as women are trying new looks. They're using their time at home to do things, to experiment, to try new things for entertainment. And so the real two trends that we see are, one, she really loves her routine. She loves her self-care and her rituals, and they're calming and they help her at a time of high anxiety. And so that investment is something that makes her feel good. The other thing that we're seeing is, like I said, women are experimenting with new looks and enjoying, using their time at home to try things. So we're seeing new looks in terms of makeup, lots of new hair color styles, things of that nature. Looking at pure play e-commerce overall, it's starting to level off. So this is representative of some of the other trends we looked at, where you can see that baseline back in February. We saw again that decline and that dip back in March, and then we saw strong resurgence and adjustment, kind of the pendulum swinging the other way in April. And then things started kind of normalize to a new elevated normal, closer to baseline back in May. The one thing that we have noticed recently is that, heading into Memorial Day and also heading, in the last week with a lot of the protests that are taking place, that, really there's a pullback in terms of activity again. It's very similar to what we saw in March, where, brands really want to stop and think and take a measured approach to their messaging, their communication, their investment, and really their objectives in terms of what they wanted to accomplish at this very unique time. And so you can see that things had fallen off a little bit for the first week of June. And I would say, as much as anything, this is such a unique time. It's very, very important to really take a look at the macro trends and look at how this is evolving on a week by week and even month by month basis, because it's unprecedented. The types of things that we're going through this year are very different than a normal year in terms of e-commerce. And so as you look at your own performance, and as we advise Stella clients, we're typically making sure that they're not just looking at it through the lens of how their business is performing to make decisions, but looking at it from the overall broader sense. As we look at categories, this is a comparison of the weekly index of what we're seeing in terms of retail channel, the overall sales 2019 compared to 2020. The dark purple represents the most significant, delta in terms of over indexation compared to the baseline. And you can see here the things that are really represented as in the dark purple are the areas that we're seeing significant growth over last year in terms of retail sales. Home improvement and online clearly are the ones that have the most consistent recent dark purple. And those are things that we're seeing consistent, where people are spending more time at home, the weather's getting nice, they're investing in making their homes nicer, and they also have a lot more time on their hands, given that there's less activities, there's less socialization, there's less sports, at least heading into the summer than normal. Online spend, as we talked about earlier, is something that, as people are not going into the retail world, they're replacing with online spend. And then the next one that's dark purple there is actually liquor. And so people are enjoying their quarantinis and, winding their days down, hopefully not socially medicating too aggressively, but people are still visiting the liquor store pretty aggressively. Food and dollar and club are the other areas that seem to be doing well. And really what it is people obviously are continuing to invest in needing the necessities like their groceries and staples, but also are looking for value. So things like club and dollar are doing, better than normal, because people are choosing to, make less visits than they have to, and they want value when they do. So club gives you the opportunity to get value and bulk, so you can get larger quantities for a lower price and make less frequent visits to the store. And dollar obviously represents, for value. So as certain households are struggling a little bit more financially, making more trips to the dollar store does make more sense. And the categories I really think that really have suffered the most, at least according to this data, are certainly you can see the beauty stores, which have been closed essentially. The category's been closed until very recently, as well as C-store and gas. People aren't really running into those stores. Many of them are closed in different areas. So those are really the laggards, and you're seeing a displacement in terms of where that spend is happening. So at Stella Rising, we also keep track of all of our clients and keep tabs on the trends in terms of what we're seeing within our client portfolio. And as you can see, our beauty portfolio has been pretty consistent in terms of what we just talked about. We didn't see quite the same level of declines in March as a category overall, but the overall trend lines are continuing to improve over time. Our beauty revenue overall has been on the rise since social distancing started by about 48.5% and up 33% just from just a year ago. We're on the retail side, it's really a little bit more dependent on category. So in our portfolio, we have exposure to luxury brands, jewelry brands, and other brands that were hurt a little bit more early on by the pandemic. And you can see that trend line is also improving. So we're seeing a little bit more strengthening within that section of our portfolio over time. And our everyday brands are pretty much holding steady or improving. And by everyday, we really mean those kind of non-luxury, kind of standard retail brands. We're also seeing video completion rates remaining strong throughout the COVID period. After we saw social video completion rates kind of plateau a little bit, they've been again on the rise the last couple of weeks. We're seeing YouTube video completion rates up 99% versus the prior period, and Facebook and Instagram video completion rates up 5%. Google and social have kind of started to return to pre-COVID levels and normalize. There's a little bit of strengthening recently, but we're seeing them kind of return more towards the normalized mean. And that's across all Google products and everything else. So we're still seeing CPCs are down a little bit and click-through rates are up a little bit from where they were. But after seeing some strength in April, we've seen things kind of regress a little bit further there. So from our partners at the trade desk, they have a view into the entire bid stream for any programmatic transactions that take place. So any media that's purchased, whether it's video, whether it's mobile, whether it's desktop, whether it's native, they're able to see every single bid ask transaction and request through what's called the bid stream. And so they're able to share with us what they're seeing in terms of overall programmatic ecosystem inventory availability and pricing. And so you can see a very similar trend in terms of what we just looked at, which was in March, we started to see a real divergence in terms of the available inventory and the CPM. So as brands started to really question their strategies and should they be investing in certain categories, certainly that were hurt immediately, like hospitality, QSR, travel, as those brands started to pull out of the marketplace, that led to more available inventory. And if there's more inventory, supply and demand would dictate that pricing would come down. So we saw that divergence really take place until about the end of April, beginning of May. And you can see that convergence start to happen again. There's been a little bit of kind of a crisscrossing that kind of happens, but we've kind of reached that regression to the mean again. We're back to kind of normalized baseline levels. But we are seeing that, pricing is still down from where it was, even though we've kind of normalized a little bit. And this data has held consistent, although this data only goes to May 11th. The trade desk has not been pushing this out any further because they said all trends have pretty much held consistent at this point in time. So what does that mean? Well, change in CPMs by channel and market are pretty consistent. In the pink here, you can see across the open exchange that for almost every single channel, meaning by the type of media and by the type of device, essentially, we're seeing that overall rates, CPMs have come down consistently, with the very few exceptions in terms of open exchange mobile video in-app, and private marketplace native. But with the exception of that, you can see that for the most part, pricing has come down consistently across the board. And so kind of looking at the most recent refresh on data, what were the trends by channel? If you compare March to roughly mid-May, native video saw a significant increase in inventory. Mobile in-app CPMs took a decline. Mobile standard web CPMs remained flat, while inventory saw a slight decline, and there remains inconsistencies in mobile inventory by channel. So what's next? Now that we've kind of gotten a look in terms of the data and we understand how consumer behavior has shifted and held consistent, we're seeing e-commerce is up, but starting to normalize a little bit. What's happening now that retail is opening? Well, as we touched on earlier, there was just a recent revision that e-commerce growth is forecasted upwards. So from 13% by 5 percentage points to 18%. And that's great. We're seeing strong growth in e-commerce. So certainly, DTC and e-commerce centric brands are able to benefit from that trend. But for omnichannel retailers and retailers at large, there's still expected to be a significant decline in 2020 by roughly 10.5%. Some predictions are saying it's going to take as long as 5 years to return to pre-pandemic levels. And so while e-commerce growth is happening and it's recouping some of those losses, it's still not recouping most of those losses for most brands. And so we have to really think about, what does this mean for brick and mortar, and what does this mean for businesses that have a significant brick and mortar footprint? So it's going to really matter state by state, even market by market. So we know that states are now reopening, some as early as April. A lot of markets started to open, especially a lot of the southern states, and as recently as New York, even opening in the this past week. So as they reopen, it's going to be very important to pay close attention to what's happening with consumer behavior, consumer sentiment in those markets, as well as what's happening with the overall number of COVID-19 infections, because that's going to really dictate, I think, how consumers are going to react in those local markets. So we're going to look at about 6 different data points. This data comes from Google, given that they are able to see and track a significant amount of consumer behavior through their mobile devices and browser activities. They're able to give a pretty good understanding of the types of places that consumers are going as states reopen. So we're going to compare 2 southern states that have reopened with similar but different consumer activity. And we're going to compare that with New York, which opened just this past week. So, and again, this data goes through the end of May, so this will not factor in the recent opening and shifts in consumer behavior in New York. So if we look at South Carolina and Georgia, as they start to open up their states in April, we're seeing now a shift in terms of people are starting to go back to retail and recreation. So if you look at the beginning, they were down about 40% when they were closed. And then after reopening, now they're down 10% and 16% comparatively. New York, you can see, even though it's still closed, was down roughly, almost 60%, and it's down 47% even before opening. So again, still a lot of people are staying in place in New York. Grocery, pharmacy, similarly, people are still kind of only going as much as they need to. There's not as big of a shift there because people still needed to go to the grocery store. It was in pharmacy, right? For medicine and groceries, those were necessities. So you don't see a very, very large shift in terms of their behavior. Even in New York, it was only 11% delta. Well, how about parks? Parks are open air. People feel a little safer going out to parks. You're able to socially distance more safely versus indoor environments. And so you can see the jump there where, it's about 22% from baseline in South Carolina at 44% in Georgia. But even in New York, it was down 40%. You're seeing now it's up 3%. So, across the board, you're seeing roughly, a 40-ish% uptick in terms of park activity. So the other 3 data points we looked at were kind of transit, and thinking about people going back to the workplace compared to staying home. And so you can see here similarly, Georgia stayed relatively flat. There wasn't much commuting taking place and it hasn't really changed. Whereas South Carolina went from roughly a 40% decline to, back to baseline. So things are kind of more normal in terms of commuting within South Carolina. New York, again, still staying significantly suppressed. And of course, commuting in New York, you have subways, you have buses, you have lots of people, and people are very fearful, of getting exposed in those, tight, congested commuting environments. And workplaces and residential really, offset one another. And we're seeing that, again, people are starting to go back to work. There's still a decline, though, as many people will continue to work from home, even as states open up. So you can see in South Carolina, even though it was a 40% decline, it's only gone to roughly a 29% decline. Same thing in Georgia. So even though states are opening back up, people are continuing to work from home at pretty consistent levels. And you see similar patterns in New York. Time spent at home, however, has shifted a little bit more, but is also pretty normalized. So what this shows is that so far from opening, people's work habits, working from home versus going back to work, and how much time they're spending at their home, although, it's changed a little bit, is pretty consistent. So one of the other big factors is going to be, well, what happens in terms of the number of cases within these markets? And so the New York Times has been publishing this data on a regular basis, to basically show what's happening state by state in terms of when the stay-at-home orders were in place, when they reopened, and what has happened in terms of the number of cases. You're seeing this change on a daily, minimal weekly basis, with some places reporting as high as half the states are seeing increases in the number of cases. There's a number of southern states that are starting to spike again. Arizona, Texas, Tennessee, Florida is now of concern. And those were some of the states that had the quickest return to reopening policies. And so it's going to be important, again, depending on where your business is located or what your retail footprint looks like, to be paying attention market by market. Because I think the number one factor in terms of what happens with your retail is going to be how comfortable people feel going into those retail environments. If there's a significant spike in terms of the number of cases in a local market, people are going to be much less likely to put themselves at risk and go into the physical retail stores for non-essential items. So New York, we can see, is in wait and see mode. As it just reopened, we're seeing some cases start to uptick. It's going to be something we're going to have to watch very closely. So the other thing is, there's no modern precedent for returning from a pandemic in today's time. You see a lot of comparisons to 1918, which is 100 years ago. It was a very different world. It was a very different economy. It was a very different time. And, the information, the technology, everything, the testing, everything was very different from today's day and age. They didn't have e-commerce back then, right? People had to go to the physical stores to buy goods if they didn't, produce them themselves. So what's interesting is that you don't see really consensus across economists on how things are going to return to normal or when they're going to return to normal. And in the past month, you've seen a shift of, the W-shaped recovery getting popularity, where there'll be a spike, a decline, a spike, a decline. You've seen a lot of V and U-shaped kind of taking more of the popular, point of view from different surveys, and the L-shaped recovery. And the difference is really just how steep is the decline in terms of GDP reduction, and how long will it take to recover from that decline. And so you can see those three different models represented on the left. Overall, I think the biggest question is going to be, how long will it take for us to get back to normal? The biggest factor is going to really be, when is there going to be an actual vaccine? When are people going to feel safe? When is the anxiety level going to be low enough that they feel comfortable returning to the retail environment without risk of infection? And so I think part of the reason the economists can't really agree on a specific time frame or model is because they don't know the answer to that question. Even when you talk to epidemiologists, they don't know for sure, when there'll be a vaccine. They think it's optimistic to have one by the end of the year or Q1 of next year, but it's more likely to be 2022 or 2023. So depending on when that happens is really going to have the biggest impact when things truly get back to normal. And the longer we have reduction in retail, the bigger the financial burden and impact on people, and it kind of becomes a momentous event. So right now, the leading responses are that most economists are expecting a second half 2022 or later than second half 2022 recovery back to what GDP was. So the point to make here is it's more likely it's going to be a longer recovery than a shorter recovery, and we should be planning accordingly and hope that we get upside surprises with some surprise breakthroughs with vaccines and treatments. So related to that, the consumer response to reopening is really mixed. We are seeing in general that consumer anxiety is decreasing. It's down from 13% to 7% over the last 2 weeks. So people are getting more comfortable as things reopen and cases are down. That's helping anxiety. Health concerns are still overshadowing financial concerns. So even though health concerns are decreasing and financial concerns are increasing, they're still valuing health over financial concerns. Consumers are starting to feel safer doing ordinary things. So now 42% are comfortable going to the store. 30% are comfortable staying in a hotel, and 23% are comfortable taking a flight. Those numbers were almost 100% lower, less than a month to a month and a half ago. So, although they're still on the minority of the percentage, they're improving in terms of consumer comfort. But then in addition to that, you're really seeing that there's a group of people that really want to get back into retail. There's articles out there about revenge buying. Some consumers feel like they've been on the sidelines, they miss the retail environment, they miss shopping, or they want to reward themselves for having endured hardship, and they want to get out there and buy that item they've been putting off. They want to get that luxury item to treat themselves because they haven't been buying those things, and they want to reward themselves. In addition to that, you're seeing that some of the younger demographic are much more likely to come to stores. Gen Z has, 1 in 3, 27% of Gen Zers have said that when stores reopen, they're going to be in stores within 3 days. They can't wait to get back to the market. And I think, again, that's representative that they feel safer. They don't feel as much risk. They don't think the disease will impact them personally as much. So they're excited to rush back to retail. I think, so if you have a younger consumer base, you're likely to see a better initial response. You could see an initial surge as well, that pent-up demand of people that want to get back to retail. There might be a blip across all demographics before things start to move back towards this new normal. Conversely, if you have an elder demographic, there's a very good likelihood that you're not going to see a big bump in terms of in-store retail shopping. Because again, they're still concerned of their health issues and they don't see things have really changed. So again, this is something to think about for your business, who your target consumer is, and which markets you're in, depending on how the overall opening and disease rates are. So retail is going to operate in this new normal. Those of you that have been to retail have probably seen a lot of these things start to take place. We're seeing these things in Asia as they've reopened. And these are really just to help consumers feel safe and stay safe and make sure that the work staff within those stores stay safe. So you're going to see continued store restrictions, reduced hours and maximum occupancy rates. You're going to have to wait outside for people to come out of the store to help control the overall traffic and prevent overcrowding. And there's likely going to be state-by-state recommendations on that. And there are, depending on the type of business that you're in, the square footage and distancing requirements. So for instance, gyms in the state of Connecticut where I reside, they can only allow people within 12 feet of each other versus most other retail environments where it's the 6-foot social distancing. So, make sure you check your local regulations in each market for those things. Physical measures, employees wearing masks, consumers wearing masks, plexiglass barriers at checkout, one-way directional aisles, distant markers at checkout to keep people socially distanced from one another waiting in line, people guiding people within lines to keep them spaced out, sanitizing stations. All those things are going to continue to operate in this new normal to keep people safe. Curbside pickup will remain popular. In fact, I wouldn't be surprised if it becomes more and more common for people to call stores, to place orders online and pick them up in store. That's something that has gained a lot of traction in this environment, and I think it's something that will help retail stores, keep people out of the stores, but still get them to buy their goods and services. So especially for the mom and pops, if they don't have a good, online or phone ordering process, it's something to really think about. Temperature checks to prevent anyone potentially infected from spreading the disease in the store. So I went to get a checkup recently, and going into the hospital, they scanned my forehead, made sure I didn't have a fever, and had me hand sanitize immediately. I think you're going to see that more common in retail environments as a requirement versus just in hospital environments. And also return policies are likely to become more flexible over time to minimize store traffic and dwell time. And so we haven't yet seen how that's going to play out consistently, but I would anticipate stores will get more flexible with that over time. So that said, I'm happy to take any questions if we have them. Again, I'm Brandon Heagle, Chief Digital Officer here at Stella Rising. Happy to take questions now if you'd like to submit them, or by all means, feel free to reach out to me at the email on the screen, bheagle@stellarising.com, or Marlea Clark, who opened us up here.
Hey, great. Thanks so much, Brandon. That was so terrific. Really enjoyed that. I think we have time for one quick question today because we did get a late start, but it's a great question. So I'd love to have you touch on it,
Sure.
Which is, given the various economic recovery scenarios, what do you think is going to happen next, and how will that especially impact e-com?
Yeah, that's a great question. Yeah, and I think that's the heart of really the biggest question is, what is going to happen? And ultimately, I think it's clear based on, if you listen to the data and if you listen to the epidemiologists, they really all are saying we're expecting a second wave. We're expecting a resurgence. We're already seeing in markets that have opened up. There was a lot of hope that, with the summer months and it being warmer, that the virus wouldn't make a recovery, but we're not seeing that in the South. The virus is coming back, and we're seeing an increase in cases there. So it's very likely we're going to see a second wave, not just across the country, but globally. We're seeing, in South America and in India and in other places that, there's really still a surge happening globally. So until we have a vaccine, I would expect the virus is going to be here for quite some time. And it's going to have a significant impact for quite some time. And even after there's a vaccine, there's a lot of speculation that it's going to be recurring similar to the flu, where now that it's in the human environment, it's going to stay in the human environment for some time. And there's also questions about mutations. So really the biggest thing is that, we're going to have to make sure people feel comfortable. And when cases are on the decline and they feel that they've been safe for a longer period of time, they're going to return to retail. Again, younger people, more comfortable, they're going to return to retail more quickly. But until there's a vaccine and people feel overall like they're going to be safe, there's going to be dampened retail expectations. So of course, just like we've seen, we're going to see elevated levels of e-commerce spending. People are going to continue to minimize their store visits, and they're going to maximize their purchase volumes and quantities when they do to keep trips down and keep volumes up. And they're going to continue to supplement what they do need through e-commerce. So I think that we're going to see, until people really feel safe, it's going to have a direct impact on what happens in terms of overall rush to retail.
Yeah, it's such a transformation and change. Thank you again so much. I think everything you said is I'm like nodding vigorously. So it's really great. I thank you again, Brandon, and thank you to everyone for joining us. As Brandon said, please feel free to reach out to Brandon directly, to me with any follow-up questions. We are taking next Friday off of Stellavision for a company celebration of Juneteenth, but please join us in 2 weeks for a discussion with our strategy lead, Emily Garvey, on what's happening with Walmart.com and how brands can think about and grow on that platform. So again, thank you so much, Brandon. Thanks for joining us, and we'll see you in 2 weeks. Have a great day.
My pleasure. Thanks, everybody. Have a great weekend.